Right. So the FIC Act provides for various types of reporting, and I'll go through all of those types of reporting in the sequence. So starting, we have the cash transaction report, which is about reporting cash payments that would be made by your client. So if a Snai walks into your business and I say to you, hey, I would like to establish a trust and I will be the settler, part of what I'm investing or putting into the trust is a large sum of money and it's in cash. Say maybe I would like to put in 100,000 into the trust, but I can only transact it to you or give it to you in cash, and I'd like it to form part of the trust assets. That is when you'd have to report that to the FIC, and the threshold for this cash transaction reporting is 49,999. So when it's that close to 50,000 to that 50,000 rand mark, you'd have to report it to the FIC. However, please note, this is not suspicious behavior. Or a client may be walking in with cash, but it may not always necessarily be a suspicious behavior or a suspicious transaction. What makes it a suspicious transaction is if a client is very evasive and does not want to disclose to you the source of the funds, or perhaps even the source of their wealth, if you have to go to that extent of getting more information about where the funds are coming from. All right. And then we've got section 28A, which speaks to terrorist financing. And this is an obligation on your part that we place on you as an accountable institution to report all clients or all individuals whom you would have found against the or on the terrorist property register or list rather. So how this process goes is the director of the FIC uploads a list of individuals who have been designated under the United Nations Security Council list. They have been identified as people who are associated to terrorism or who have maybe performed acts of terror or have inflicted terrorism on a community or in a country perhaps, or even people who finance terrorism or any links to that. It could be an individual or it could be an entity. And when those people have been designated, there is a public list and they would know about it too. So there's a list that is published, and then you'd have to access that list and screen or scrutinize your clients against it in order for you to know whether you're dealing with an individual who is a designated or an entity that has been designated. And there you cannot proceed with the transaction if you find that person to be a positive match to the list. You cannot proceed with the transaction. You'd have to stop all transactions with them and report them to the FIC immediately. Right. Then we go on to suspicious transactions and suspicious activities. And these are activities where a client is being maybe evasive. They don't want to disclose all the information that is reasonably expected to be shared with you as someone who would be managing their trust or managing the company. Say, for an example, the client is being evasive about who the ultimate shareholders are. They don't want to tell you that, or perhaps they are insistent on you creating a very complex structure of the company if you're maybe administering or creating the structure of a company. If they're very evasive about that information, or maybe they present to you information that may look very suspicious. Maybe they want to transact with bearer shares, for an example, then that is where it would raise suspicion to you. And if there is no legitimate reason for them requesting a transaction to happen in that sense, then that's where you'd have to file a suspicious transaction report to us, or suspicious activity, depending on the circumstances. All right. And then there's the IFTR, which mainly speaks to cross-border transactions that need to be reported to the FIC. So when there is money coming out of the country, I think, if I'm not mistaken, the threshold is 20,000 Rand at the moment. And if a client then makes a transaction with a different currency and it is coming into South Africa, and obviously would have to be converted into South African rands, if that conversion then meets the threshold in rands, then those finances, or those funds rather, would have to be reported to the FIC. if you want to read, in fact, not even a matter of if, but to understand the rules and the expectations and the obligations that we have set upon you for cash transaction reporting, please refer to guidance note number 5B, and there will be more of an explanation and a very comprehensive explanation of what is expected of you and as an accountable institution. And also just for your understanding as well, because we see in our PQPs when accountable institutions log in queries, they will often confuse a cash transaction with a suspicious transaction or suspicious report. And those are two exclusive, they are actually quite exclusive from each other. They're not exactly the same, but a cash transaction can then at a later stage raise suspicion, which then you would have to find. But there is a slide that speaks to that that I will address in a short while. So with cash threshold reporting, like I said, the threshold, or it is triggered where a client transact an amount of 49,999 Rand and 99 cents, and they have transacted in cash, coins, paper money, or a traveler's check. This does not speak to EFTs or electronic transfers. And this has to be reported within 3 days to the FIC. The obligation is to report in terms of Section 28, and this is the amount that is paid to you exceeding 49,000 Rand, and it is either paid to you or you have received, if you have received it, or you are asked by a client to pay out 49,900 Rand at minimum in cash. So it goes both ways. If either you are the one that has been requested by your client to make a cash payment to them that is of 50,000 Rand, or if your client has made a payment to you for an amount of 49,000 Rand. Sorry, I'll keep saying 50,000 because if you round it up, it actually is 50,000. But the exact amount that is provided for in our regulations is 49,999 Rand 99 cents. All right, so you'd then wonder, when would a cash transaction report be suspicious? That is when, say, for an example, a client walks in with 50,000 Rand into your office, and then they say, hey, I'd like for you to invest this, or I'd like for you to transfer all of these funds into my trust, into my family trust. But please do not just try to make it look very suspicious, or maybe make the transfer in tranches. So perhaps they ask you to make a payment of 20,000 Rand, and then 10,000 Rand, and then another, because it falls below the threshold. So if they ask you to behave in a very suspicious manner, or probably even illegal manner, then that is where it would raise suspicion. If the client does not want to let you know or tell you what the source of the funds is. So if the funds may have been from the sale of drugs, or from who knows, human trafficking, whatever the case may be. And the reason we require you to report these transactions is because cash is very difficult to trace, and our responsibility as the FIC is to protect the South African financial system, and possibly even the global financial system. And in order for us to do that, we cannot escape the fact that in South Africa, especially, it is a very cash intensive environment. And this was one of the findings in the MER way back before 2022 when we were grey listed. It was one of the concerns that South Africa deals heavily in cash. I mean, we've got taxis where people pay in cash. We've got tuck shops where people buy in cash as well. So it's a very cash intensive country or environment. And because of that, it slightly then increases our risk and our vulnerability to money laundering. And that is why you have to then file a report with us. So in the event that you are dealing with a client who is paying for your services in cash, and they are not willing to offer some information around where the funds originated, that is when it becomes suspicious, and that is where you are absolutely required to report that to the FIC as a suspicious transaction. Okay, so just note the difference between the two. This is also applicable to money that has been transferred from across the borders. So if a client walks into you with a foreign currency and it's in cash, and they'd like you to convert the funds for them, and they amount to that threshold of 49,000, you are required to report this to the FIC as well. And there are goods and services, obviously, that may be offered by you as an institution that would warrant this type of reporting. So your the money laundering and terrorist financing control regulations outline the minimal client information and transactional data that needs to be reported when a regulatory report in terms of Section 28 and 28A, as well as 29 of the FIC Act, is submitted on the FIC's registration and reporting system, which is GoAML. So all of your reports will be sent through via GoAML. Information that is readily available or relates to the information that ought to be available and obtained from the client, like their identification and verification, all of that information needs to be provided to us. And we usually refer to your identification and verification process as CDD, which essentially means you need to know who your client is, you need to know who you're dealing with during the course of your business with them, or during the life cycle of your business relationship with them. And that is where your obligation to report them becomes alive or is triggered. Okay. Regulation 22C prescribes the information that is to be provided by the institution when completing a cash transaction report. So then there's a bit of guidance there on what information, the sort of information that you have to provide to us when you are filing a CTR. Okay, and a cash threshold report must be sent to the FIC as soon as possible, or within, but no later than 3 days, by a natural person, and that would be obviously the individuals that are participating in the transaction that is taking place, and that requirement comes from Regulation 24. Okay. Right, like I said, CTRs are different from STRs, and I know it may sound very similar in some instances, but they're quite different. Now that we have dealt with CTRs, which focuses on cash transactions only, now we're going to look at Section 29, which addresses suspicious transactions, as well as activities from a money laundering, terror financing perspective. There's also proliferation financing, but we'll place more focus on money laundering as well as terrorist financing. Now, there is no minimum threshold for reporting a suspicious transaction. It could be a client that is walking in with a measly total of, say, 1,000 rand to transact with you, and that behavior, if it appears to be very suspicious and unusual, that can be reported to the FIC. We have not set any threshold when it comes to suspicious reporting. There are various events that need to be reported to us. So I'll give you an example of what suspicious transaction may be. If a client, for an example, has said to you, okay, in a telephone conversation, I will then make a transaction to you of about 1,000 rand, of say maybe 100,000 into my family trust, and they are not making these transactions in a way that is expected. So if you know, for an example, that your client can only afford to transact 100,000 into a family trust, but then there you are the next morning when you look at your bank statements as an institution, you see that 1 million was transferred, and from what you know about the client or about the settler, they cannot it cannot be possible that they would have had 1 million rand. You could always ask them, and they could maybe disclose to you that they've maybe inherited the money or that they won the lotto, wherever the funds may originate. That is not suspicious. So a mere transaction of a huge sum of money is not suspicious, but it is what you know about the client. If there are inconsistencies, that's when it raises flags that would then trigger an STR to us. So if your client behaves in a manner that is inconsistent to what you know about them, that is when you'd have to file an STR with us. Or if a client is supposed to disclose to you who the settler is, and they do not want to provide you with their ID document, or they do not want to tell you where the client was born or which country their nationality of, and this is information that it is expected of you as someone who is expected to manage the trust, or as a trustee, you're someone who's supposed to offer a trustee service to them, but they're very evasive. They're not very willing to hand over the information. They're not very forthcoming with information that should be known to you. That is suspicious behavior. If they are trying too hard to try and hide who the beneficiaries are and who a settler might have been, then that would trigger some suspicions to you, and so you'd have to file a suspicious report. Now, there are common reporting errors that we have found. I will not delve too much into it because Gwanele is going to speak to reporting, but some of them are like non-adherence to defined reporting timelines. Like I said, with the CTR, for an example, that you have to report within a period of 3 days. So if you've gone over the 3 days, we find that some of the reporting is done at a much later stage, and that becomes a bit problematic. And you may even have to provide reasons to us as to why the report was not filed in sooner or within the timeframes that the FIC Act has prescribed, or sorry, that our regulations have prescribed. And not all products and services are identified. So in your reporting, where you have not in very great detail explained to us what products your business offers and what services they offer, so in order for us to then identify the suspicion in the behavior in the greater scheme of things, that in itself, it can be a bit of a problem for us to sufficiently address the suspicion around that and then do what the FIC needs to do with that intelligence that you would have provided to us. When reports are not completed in full, there's missing information. It's very difficult and almost impossible to look into anything or investigate or do an analysis on information where there's information that is missing. So, and this is often said that intelligence and information is the FIC's bread and butter, and we function through that, through the provision of information by yourselves, by other accountable institutions that are provided for in Schedule 1 of the FIC Act. So as much information as you can provide, please do so. Please provide that information to us, because then it creates the bulk of our work and it enables us to successfully identify suspicious behavior, maybe even criminal behavior, and deal with the information in a manner that we have been mandated to. Beg your pardon. Right, when reports are not being checked before being submitted, it is always a good thing to do, and it's always ideal to do a bit of proofreading before you submit anything, really. So this applies also to suspicious transactions where you are reporting to us or you're filing a report to us. It's always ideal that you just do a bit of proofreading to make sure that the person that is on the receiving end of that report understands the message that you're trying to convey. We're not asking you to be investigators. We're not asking you to probe your clients to the lengths where they are even suspicious now of you, or they are being tipped off. But we're just saying, please provide as much information as you possibly can so that we will be able to work with that information. When the events that have been reported to us are not all reportable, and we've identified that that can be problematic as well. So just ensure that you understand what an STR is, or sorry, what suspicious behavior and suspicious transactions are, in order for us to provide us information that we will most likely need and use as well. And then there are rejected reports that are not remediated. Kwanele will go through that process with you of what you do in the event that your report is rejected and it needs to be remediated. Okay, so Section 9 is explained in length and very comprehensively in Guidance Note 4B. You'd have to please read that in order for you to understand a little bit further what your obligations are when it comes to reporting all the different types of reports, which include the suspicious activity report, suspicious transaction report, terror financing activity report, and terror financing transaction report. There are many of them, and I know that we speak a lot with abbreviations, and we use a lot of acronyms, and it can be a bit confusing at times, and we may think that it's easy, everybody understands, but we also understand that you guys are industry experts, and you have your own acronyms possibly that you make use of. So where it becomes a bit of a mouthful exercise from our end, please, we do apologize for it, but a lot of what we speak about is often explained in detail in our guidance notes. notes and in our PCCs. And when you have a read at those, then it will slowly start making sense to you. Okay, so I've touched on suspicious activities and behaviors and unusual behaviors that you may identify. I'm not going to go into great detail on that. I'll just touch on maybe the first three, where proceeds are of from an unlawful activity. Again, say maybe your client deals in trafficking people or or children, or if they maybe deal in drugs, the sale of drugs, or the sale of maybe stolen cars, and they only transact in cash, for an example. That would be suspicious behavior, and also it is an unlawful activity that generates your client's income or your client's funds, that they would then use you to try and hide those funds for them. So that is suspicious activities that would require you to report to us. Where you facilitate a transfer of proceeds of unlawful activity, again, I think I've just explained that. And then where there is no apparent business or lawful purpose for a transaction that is taking place. So in the event that you find that your client has come up to you with a proposal to maybe establish a business for them, put together a company, but you realize that there is no lawful purpose for this company existing, and it is very suspicious as well, it is suspicious behavior, then you would be required to file in a report to us and detail to us what about the behavior of the client that is very suspicious and that we should look into. Okay, and then there's also the tax reporting, where a client wants to evade tax, and obviously there are events where a client will maybe make some payments and we don't know what the reason for them choosing or electing to make a payment in a particular way, but where you have strong suspicion that the purpose is to evade tax and there is no legal and justifiable reason for them avoiding tax, which is legal, and they want to evade tax, obviously then that needs to be reported to us. Offences relating to terrorist financing, there are many activities that are suspicious that you'd have to report to us in the event that they occur in your business relationship with a client. Other suspicious behavior includes clients who insist on being anonymous. They do not want to be known, and Section 21E of the FIC Act deals with that where you are, first of all, you are not allowed in terms of the FIC Act to deal with a client who wants to operate anonymously. You are required to identify and verify your clients, and this forms part of your CDD process. And if your client is evasive and does not want to be forthcoming with that information, they don't want to tell you where their country of birth is, for an example, or their country of nationality and who they are as an individual, and if they don't want to give you a name that they are legally known as, that is very suspicious behavior that you'd have to report to us. So you must obtain all of this information, and the process in which you will follow to identify and verify your clients must be in very clear detail be explained in your RMCP. Sometimes you may find that because the regulations and AML laws have changed over time, if maybe say in the year 2000 you were never required, and this individual was already a client of yours and you were never required to perform CDD. As the years evolved, obviously legislation changes and then the requirements present themselves and they may become stricter. So then that means you have to now remediate your client file and do ongoing due diligence, and it forms part of ongoing due diligence. That is where you'd also have to now identify your client and know exactly who your clients are. There is no monetary threshold when it comes to suspicious reports. And that is because it could be suspicious behavior or suspicious transactions, and a transaction does not have to be a huge amount of money for it to be suspicious. Equally so, a low amount of money does not mean that there is nothing to be suspicious about in a client. You would have to look at, approach your case holistically and look at, well, in the greater scheme of things, is this normal behavior? Is this suspicious behavior? Is this behavior inconsistent with what I know about my client? If my client said to me, I'm a teacher, for an example, and I earn 20,000 Rand, but then you start seeing payments of 50,000 Rand on a weekly basis that are made by your client, that is suspicious behavior, because you look at the industry that they're in and maybe the duties that they perform. And if it is maybe unlikely that they would always have such huge amounts of money on such a regular basis as well, well, and there's no justifiable reason as to why they have those amounts of money and transacting them into your business account, then that is suspicious behavior that needs to be reported. So it does not have to be huge amounts of money. If an investor comes and says, hey, I have 100,000 that I need to invest, and this is where the money comes from, again, that is not suspicious because you know where the money comes from, and the investment maybe might be very legitimate as well. Okay, so a suspicious transaction can happen either in a completed transaction where you have completed all of your transactions with that individual, and then you realize that actually there's something very suspicious about this client's behavior, or it could happen over a series of transactions that are made by your client. So it really is about you being mindful about your interactions with your client, and also applying your industry knowledge and your business knowledge and understanding of how your area of work, or your how your area of work operates. If it is normal behavior for many transactions to be sent to your entity, then, and it is justifiable, and when we walk in, we do our inspection and we find that you have been accepting many different small payments. If it is justifiable and it is legal, then that's perfectly fine. Those series of transactions are not suspicious at all. But where even you as an industry expert, you cannot explain to us as the FIC why you have accepted payments in tranches, there is no justifiable reason for that, then that is where it becomes problematic, because now we are suspicious that there's an unlawful activity that is taking place, and perhaps the funds are unlawful themselves, and the client is trying to use you as as an accountant, or as a TCSP, so TCSP or CSP, to hide those funds. That is when it becomes problematic, and it obviously wouldn't end really well. Right. Who is expected to file an SCR with us? It is anyone, any person who carries on the business, or oversees a business, or manages a business, and is employed by a business. There is no meaning or definition in the FIC Act of what a business is, so we just take the ordinary meaning of the word. But essentially what we're saying here is, if you're in a company and you offer the services of establishing a trust, managing a trust, being a trustee, or maybe acting as a nominee, maybe for a shareholder of a company, and you are in that business, it's part of your business offering, and it's part of business operations, and it's part of your service offering. If the suspicious behavior happens in that sort of environment, that is when you would be expected to file a Section 29 report with us. The OECD convention report also speaks to other types of financial crimes that may be very suspicious and that you have to be very much aware of, and that includes bribery. So, and it may include also PEPs and PEPs from foreign countries as well. It's quite a lengthy report that you might like as a bedtime read, but essentially what it speaks to is reporting proceeds that emanate maybe from an individual trying to bribe you, as a what we like to call gatekeepers as well of the financial system, or as an accountable institution. You'd have to report those to us if you're, and it can be successfully detected in an investigation, maybe by the National Prosecuting Authority, or by whoever that has the duties and the responsibilities of investigating such financial crimes. But essentially what we are is, once again appealing, is that you are aware of these incidents, and of not facilitating bribery or events of money laundering, or activities of money laundering and terrorist financing. And where you do identify such behavior, you report that to us, and you do not enable that sort of behavior to keep happening. All right, so a suspicious report must be filed within 15 days, or by no later than 15 days to the FIC, all right, where a report relates to an activity that does not involve a transaction between two or more people. That is when you would sorry, if you are not reporting, if an event that you're reporting does not involve a transaction between two people, you still have to file it if it is suspicious, or in the event that the transaction or a series of transactions about which requires about which an inquiry is made are filed and they have not been concluded, you still have to file a report with the FIC, or even if the transaction is incompleted, interrupted, aborted, abandoned, or ultimately not concluded. So for an example, if a client behaves suspiciously and they then realize that you're picking up on it and you are about to, or you might file an SAR with us, a suspicious activity report with us, and they decide to abandon the transaction, you are still required to file a report with us. And we understand and appreciate that there in that case, the information might be very limited, but still we would require you to detail to us what about the behavior it was very suspicious, and we would then do with that information what we can. But essentially what the slide speaks to is even if a transaction does not take place between two people, it is not concluded, it is not completed, you still have an obligation as an accountable institution to file that report with us. And then when it comes to terrorist financing as well, you are prohibited by law to enter into a business relationship with people that are related to terrorist activities or related to such activities. So the law bars you from doing that. And in the event that you find your client as a match in the list that I spoke about earlier on, you are then required to stop all transactions with them, and you have to file in a report with the FIC. But when it comes to terrorist financing activity reporting, even if you have not maybe found your client in that list, which is a Section 28A requirement, but for Section 29, where your client is involved in terrorist financing, maybe they tell you that they are transacting the funds to an NPO, for an example, but you cannot really understand what the relationship is or why they would want to finance that NPO, and maybe that NPO is based in a country that is known for terrorism or for managing or performing terrorist acts, then you would have to, that would raise suspicions, and you'd have to file that report with the FIC even if it is not completed. Right, so I've touched on Section 29 in detail. And when you are reporting now, what are the implications of once you have filed an SCR with us, what happens is the question. Do you proceed with the transaction or do you not proceed with the transaction? How do I know if I'm breaking the law if I do proceed or choose to proceed with the transaction? Section 33 of the FIC Act enables you to continue with the transaction if the FIC has not directed you to stop with the transaction in writing. Okay, so a reporter may continue with and carry out a transaction unless the FIC directs the reporter not to proceed with the transaction, and that is Section 33 of the FIC Act. Section 34 proceeds then, or is an extension of that in a way, because it says that the FIC may direct the institution in writing not to proceed with a transaction for a prescribed period of 10 days. And if you get that instruction in writing, then you cannot proceed, you cannot continue with the transaction, at least for a period of 10 days. Until then you'd have to wait and then proceed with your transaction after the 10 days, or if the FIC instructs you a little bit further after that. Tipping off is a crime. You may not tell your client if you have filed an STR. You may not tell your client that you have filed one, why you have filed one, and what it is about. They cannot know this. It would get you into some serious trouble. What you can share with the client in the event that they ask you is if you have filed a Section 28A report, because this is a publicly available list, and they most likely know that they're on that list in any case, or at least they can check the list themselves and know that they are present in that list. So when it comes to Section 28A, there is no tipping off that you should be concerned about. But when it comes to Section 29, which speaks to suspicion, and also the reason for that is because suspicion doesn't mean that the event is actually as you understand it or perceive it or suspect it to be taking place. It may be just a red flag that could have been addressed with a bit more probing and a bit more questions, and it will be successfully addressed, and then you can proceed with the transaction. So I know that it can be a very difficult one to deal with, especially when you're dealing with a client. They're getting antsy, they're getting frustrated, they want the transaction to be issued and finalized. I understand that fully. But there are behaviors that are just so suspicious that if you were to disclose that to your client, they would know about it, and then that would now get in the way of our duties as the FIC to deal with information as we should. So please be very mindful of the differences between all these types of reporting and understanding what duties or implications follow after you filed those respective reports. Okay, so Regulation 24 is in relation to Section 29 of the FIC Act, which says that the reports must be sent to the FIC as soon as possible after a person has become aware of the facts which give rise to a suspicion. Again, it is suspicion, and you may not necessarily know, and we're not asking you to be investigators, but if behavior is suspicious, then that is when you'd have to file in a report with us, and do so within 15 days, and this excludes Saturdays, Sundays, and public holidays. Right. An accountable institution is required to keep records of the report that they would have filed, and this is under Section 23 of the FIC Act. Records are to be kept for at least 5 years from the date on which the report was submitted to the FIC. Now I'm going to hand you over to Gwanele, my colleague, who's going to speak more around